If you are holding SCHD or JEPI right now, you need to pay very close attention because the easy money era of 2024 and 2025, it is officially over. For the last 2 years, you could blindly buy JEPI and enjoy massive 8 to 10% yields because interest rates were high and market volatility was predictable. It was the perfect storm for income. But the economic forecast for 2026 has completely flipped the script. We are staring down the barrel of falling interest rates, a potential AI bubble correction, and a tax bill that could eat up to 37% of your profits if you aren't careful. One of these ETFs is set up to explode in value as rates drop. The other might leave you with a shrinking paycheck just when you need it most. I've crunched the numbers, analyzed the top 10 holdings for late 2025, and calculated the tax drag for both. Today, we aren't just comparing yields. We are settling the debate once and for all. SCHD versus JEPI. Who is the actual winner for your portfolio in 2026? Intro. The Tale of Two Strategies. Welcome back to the channel. Before we pick a winner, we need to understand why these two funds are often compared, even though they are completely different animals. In the blue corner, we have the heavyweight champion of dividend growth, SCHD, Schwab US Dividend Equity ETF. SCHD is passive. It tracks an index of 100 companies with strong cash flows and a history of paying dividends. It costs you almost nothing to own, just 0.06% in fees. Think of SCHD as a snowball. It starts small, but it grows massive over time. In the red corner, the challenger, JEPI, JP Morgan Equity Premium Income ETF. JEPI is active. It doesn't just buy stocks. It uses a complex strategy of selling covered calls via equity-linked notes to generate monthly cash. It costs more, 0.35%, but it pays out a yield that often rivals a full-time salary. But here's the problem. The market conditions that made JEPI a superstar in 2022 and 2023 are fading. Let's look at why 2026 might be the year of the Great Rotation. Section 1. The Holdings Deep Dive. You can't know which fund wins unless you know what is inside them. Let's look at the top holdings as we head into 2026. Look at SCHD. It is heavily weighted in financials, healthcare, and consumer staples. We're talking about boring, cash-rich giants like Merck, Amgen, Cisco, and Coca-Cola. Why does this matter for 2026? Because these sectors, especially consumer staples and high-quality financials, are classic bond proxies. When the Federal Reserve cuts interest rates, which is the projection for 2026, investors stop getting 5% from their savings accounts. They go looking for yield. And where do they go? They flood into stocks like Coca-Cola and Amgen. This pushes SCHD's share price up. Now look at JEPI. Its top holdings are different. It holds tech giants like Microsoft and Google, but also defensive plays like Progressive and Trane Technologies. But here is the catch. JEPI doesn't just hold these stocks. It sells the upside on them to pay you that monthly check. If 2026 turns into a massive bull market because of AI optimism, JEPI is forced to cap its gains. If Google goes up 20%, JEPI might only give you 8% of that run. The takeaway. SCHD is built to capture capital appreciation in a falling rate environment. JEPI is built to survive volatility. If you think the market is going up in 2026, SCHD's holdings are simply mathematically superior. Think of it like this for 2026. Imagine two vehicles on a highway. SCHD is a race car. When the road gets smooth, interest rates fall, and the sun shines, economy grows, the race car can drive as fast as it wants. There is no speed limit. If the market goes up 20%, the race car goes up 20%. Why? SCHD owns actual companies, like Home Depot or Chevron. When interest rates fall, it's cheaper for these companies to borrow money and grow. When they grow, their stock price goes up. You own the stock, so you get richer. JEPI is a tour bus with a speed limiter. The passengers pay you a ticket price, the 8 to 10% yield, every month to ride. That's great. But here's the catch. To get those ticket sales, the bus creates a rule. We will never go faster than 60 miles per hour. If the market suddenly speeds up to 100 miles per hour, a bull market, in 2026, the race car, SCHD, zooms ahead. The bus, JEPI, hits its speed limiter. You get your ticket money, but you get left behind in the dust. Mathematically, if the market goes up, SCHD simply wins. Quick reminder, if you're getting value from this video, take 2 seconds to hit the like button. It helps the YouTube algorithm show this to more people who need it. And if you're new here, subscribe to Simple Money Method so you never miss practical, jargon-free financial guidance. Section 2. The Falling Rate Trap. Let's talk about the income. This is the biggest risk for JEPI investors right now. JEPI's yield is not magic. It comes from 2 sources: dividends from the stocks it owns, and volatility premiums from the options it sells. In 2022, volatility was insane, so JEPI paid out 11 to 12%. In 2024 and 2025, volatility cooled, and the yield dropped to the 7 to 8% range. Now look at 2026. If the Fed cuts rates to stimulate a slowing economy, 2 things happen. 1. Bond yields drop. The risk-free rate goes down. Think of the risk-free rate as the interest you get for keeping your money safe in government bonds. When that rate drops, the safe money stops getting paid, so it floods into the stock market to chase returns, pushing prices up. 2. Volatility often compresses. Unless we have a recession, markets tend to stabilize. This is a double whammy for JEPI. Its yield could fundamentally compress. We are already seeing estimates that in a low volatility bull market, JEPI's yield could drift down towards 6%. Meanwhile, SCHD's yield is real. It comes from corporate profits, and those profits are growing. SCHD has a 5-year dividend growth rate of over 10%. So while JEPI's paycheck might get smaller in 2026, SCHD's paycheck is mathematically programmed to get bigger. Section 3. The Tax Silent Killer. This is the section most of us ignore, but it is the most important part of this video. Let's do the math on a $100,000 portfolio. Let's assume you hold these in a standard taxable brokerage account. You have a job, so you are in the 22% or 24% federal tax bracket. With SCHD. Yield, approximately 3.8%. Income, $3,800. Tax status, qualified dividends. Tax rate, for most people, this is 15%. Tax bill, $570. Take-home cash, $3,230. Now with JEPI. Yield, approximately 7.5%. Income, $7,500. Tax status, mostly ordinary income because of the ELNs. Tax rate, your marginal rate, let's say 24% plus state taxes. Let's call it 30% total conservatively. Tax bill, $2,250. Take-home cash, $5,250. But wait, you say, JEPI still put more cash in my pocket. Yes, it did. But at what cost? You paid 4 times more in taxes. And remember, SCHD's share price likely grew by 8 to 10%, meaning the IRS can't touch that growth until you sell while JEPI's share price stayed relatively flat. If you are in your peak earning years, buying JEPI in a taxable account is basically volunteering to pay the IRS more money. Winner, SCHD. Section 4. The Dividend Snowball. Now, let's look at the snowball effect. JEPI is a flat line. It pays you today, but it rarely gives you a raise. The share price trades in a tight range, and the dividend fluctuates. SCHD is a rocket ship. It has grown its dividend for 13 consecutive years. If you bought SCHD 10 years ago, your yield on cost today would be nearly 9 to 10% simply because the companies kept raising their payouts. By 2026, if SCHD continues its 10% dividend growth rate, a 3.8% yield today becomes a 4.2% yield next year and a 6% yield in just a few years. You are buying future income at a discount today. With JEPI, you are buying current income at full price. The verdict, your 2026 playbook. The verdict, your 2026 playbook. So who wins the battle for 2026? It depends entirely on your birth year. Scenario A. The Wealth Builder, age 20 to 50. If you are still working and don't need the income to pay bills today, SCHD is the undisputed winner. The falling rate environment of 2026 will boost its share price, the tax efficiency will save you thousands, and the dividend growth will build a massive income stream for your future self. Avoid JEPI. It's just a tax drag for you. Scenario B, the Bill Payer, age 60 plus. If you are retired and need cash flow to cover your expenses right now, JEPI is still a powerful tool. Why? Because even if the yield drops to 6 or 7%, that is still double what SCHD pays today. You don't have time to wait for SCHD's dividend to grow. You need to pay the electric bill next month. In this case, use JEPI inside an IRA or Roth IRA to avoid the tax hit and enjoy the monthly paycheck. My personal strategy for 2026? I am using a dividend barbell. I keep 80% of my dividend portfolio in growth machines like SCHD to capture the upside of the falling rate market. I use the remaining 20% for high-income funds like JEPI, and maybe a little GPQ for tech exposure, just to smooth out the volatility. But I want to know your strategy. Are you dumping JEPI because of the tax drag, or are you doubling down for the monthly cash? Let me know in the comments below.